There is a mortgage rule that could save your family thousands of dollars, and most lenders have never even heard of it. Here's exactly how it works. If you have a child or a parent who has a disability and needs a place to call home, there's a good chance your lender told you the only option was an investment property loan, which means higher interest rates, bigger down payments, and stricter rules. What they didn't tell you is that for families in this exact same situation, there's a completely different path available. And today, I'm going to walk you through exactly what it is, who qualifies for it, and how much money it could save your family. My name is Rebecca Foote, and I'm a licensed mortgage lender. Every single day, I talk to families who are trying to do something incredibly important, making sure that their loved one with a disability has a safe, stable place to live. And every single day, I see those families being put into the wrong loan, paying thousands more than they have to. This video is about to fix that, so let's dive in. When you go to purchase a home that you are not going to live in yourself, most lenders automatically classify this loan as an investment property. And that classification, it matters a lot. Investment property loans come with higher interest rates, sometimes a half to a full 1% higher above what you would pay on a primary residence mortgage. They also have higher lender fees, and they require a larger down payment, typically 20, but sometimes 25%. The qualifying guidelines are stricter, and for most families who are already managing the financial demands of caring for a loved one with a disability, that combination of a higher rate and fees plus a larger down payment makes the whole thing feel impossible, or could even put home ownership completely out of reach. Therefore, they either gave up on it entirely or they stretched themselves way too thin trying to make it work. And that's a shame, because for a lot of these families, there was a better option available the whole time. They just weren't told about it. Here's where everything changes. Fannie Mae and Freddie Mac, the two agencies that back the majority of conventional home loans in this country, have a specific guideline that addresses exactly this situation. It says that if you are purchasing a home for a family member who has a disability and cannot work as a result of that disability, you may qualify to finance the home and get owner-occupied pricing, even though you are not living in the property yourself. Let me say that again because it's important. Owner-occupied pricing on a home for your disabled family member to live in, the same rate and terms as if you were buying it for yourself. A lower down payment, standard qualifying guidelines. The same loan you would get if you were buying the house for yourself. This applies in two primary scenarios. The first is a parent purchasing a home for an adult child with a disability. If your child has a qualifying disability, whether it's autism, a physical disability, an intellectual disability, or another condition that prevents them from being able to work, and they are going to be the ones that live in the home, this guideline was written for you. The second is an adult child purchasing a home for a parent with a disability. If your mother or father has a disability that prevents them from working and they cannot qualify for a mortgage on their own, and you want to purchase a home for them to live in, the same guideline applies to you. The key distinction here is a disability. It is not simply about having low income or no income. The qualifying factor is that the family member living in the home has a documented disability that prevents them from being able to work. That is what unlocks owner-occupied pricing on this type of purchase. Let's talk about documentation, because this is where a lot of families get nervous. The good news is that when the situation is clear, the paperwork is very manageable. For a person qualifying for the loan, that's you, the buyer, we need the standard mortgage documentation. Your income, whether that's W-2s, pay stubs, 1099s, etc., your tax returns, your credit report, your assets, the usual stuff. For the family member with a disability who will be living in the home, here is what we need to establish. We need to document the disability and the inability to work. The most common way to do this is through tax transcripts, the official IRS record of their income history. If those transcripts show little to no income, that's all the documentation we need. If your family member receives Social Security disability income, that award letter is also incredibly helpful. It establishes both the disability and the fact that they're unable to work, which is exactly what the guideline requires. The goal is simply to tell a clear, documented story. The underwriter needs to see that this is a family purchasing a home for a loved one with a disability, not an investor who is trying to get owner-occupied pricing on a rental property. When that story is supported by the right documentation, it is a very clean and straightforward approval. Let me show you what this actually means in real dollars, because I think that's where it actually hits home. Let's say you're purchasing a home for $300,000. An investment property loan with an interest rate might be between 7 and 7.5% right now, and you would need 20 to 25% down. That's $60,000 to $75,000 out of pocket, and that's just getting started. Don't forget, you're going to need additional money for prepaids and closing costs too. On an owner-occupied loan, using this guideline, your rate could be much lower, like 6 to 6.5%. And your down payment could be reduced to as little as 5% down. That's only $15,000. The difference in monthly payment alone would be between $80 and $150 a month. Over 30 years, we're talking about well over $50,000 in savings. And if you choose to put down just the minimum 5% down, the difference would be $45,000 to $60,000 that stays in your pocket. For families who have spent years, sometimes decades, planning and sacrificing for their loved ones' futures, that is a life-changing difference. Let me answer the questions I hear most often about this guideline. Does my family member need to be receiving Social Security disability income to qualify? No, not necessarily. SSDI is one of the strongest forms of documentation because it clearly establishes both the disability and the inability to work. But other forms of documentation may also be accepted depending on the lender and their specific situation. This is something you need to discuss with your lender upfront. Remember, the most common documentation is just getting a tax transcript showing a $0 income. Can I use this loan if I already have a mortgage of my own? Yes, as long as you qualify. This guideline is specifically about occupancy situation and the disability status of your family member living in the home, not how many properties you already own. What if my family member has some income from a part-time job or benefit? Having some income does not automatically disqualify them. But remember, the key requirement is documenting the disability and the inability to work. Basically, they cannot afford a home on their own. Your lender will evaluate the full picture of your situation. There are other loan options to look at in this type of situation before you automatically have to go to getting an investment property loan. You can look at putting the family member on the loan with you, and that would solve the occupancy requirement. And you would be a non-occupant co-borrower solving the income requirement. Will every lender know how to do this loan? No. And this is what's really important. This is a conventional loan guideline from Fannie Mae and Freddie Mac, and it applies nationwide. But many lenders are not simply familiar with it. So when you reach out to a lender, just ask them directly, are you familiar with the Fannie Mae and Freddie Mac guideline for purchasing a home for a disabled family member at owner-occupied pricing? Their answer will tell you very quickly whether they are the right person to help you or not. Who does this guideline not work for? This guideline does not apply for a parent buying an adult child who has a job or in other forms of income and simply can't qualify on their own due to a high debt to income or maybe a low credit score. That's where you go back to looking at the loan that allows you to be a non-occupant co-borrower. Here's what I want every family who's watching this video to take away. If you have a child or a parent with a disability who needs a home, please do not accept an investment property loan as your only option without asking questions first. There may be a far better path available, one that can save you tens of thousands of dollars and make home ownership actually achievable. The first step is finding a lender who knows this guideline and has done these loans before. Ask the questions directly. If they don't know what you're talking about, find someone who does. If you have questions about your specific situation, reach out to me or leave them in the comments below. I read every single one of them, and I'm happy to help. And if this video helped you, please share it with another family who might need to hear it. You could be saving them thousands, and that would be life-changing to them. Don't forget to like and subscribe, and I'll see you in the next video.